Good afternoon, everybody. My name is Brent Hoover, as Carol mentioned. I run the Aiken area SBDC as a business consultant, and we're here today to talk about cash flow and credit. And I'm joined by Dory Pennington of First Citizens Bank as well. So I'll be covering the cash flow portion. Dory will be covering the credit. So let's go and look at today's agenda, shall we? And said agenda naturally involves us telling you a little bit about who we are as an organization. I'll get right into it in terms of cash flow. I'm going to approach cash flow from about three different aspects. Number one, that you might be in pre-venture. Number two, you may be emerging needing financing. And three, you may be fully matured as a business, but you're needing to make sure that you're benchmarking yourself properly. After that, Dory will introduce herself and also a little bit about First Citizens. She'll then discuss the credit analysis, and then we will finally have a review. Now, I encourage you to ask questions throughout the webinar, but please do so by typing into the Zoom chat, and we'll be able to answer those questions at the conclusion of today's webinar. So with that said, who are we at SBDC? Well, we stand for the South Carolina Small Business Development Center. We are a government program. There's no cost to what we do. We're funded by all levels, federal, state, and local. Our mission is actually to improve and further develop economic conditions throughout South Carolina. As long as you're for profit, you want to do business here in the state, we can assist. No, I cannot give you tax advice and I cannot give you legal advice, but we can connect you with those professionals. Now, naturally, part of my areas of expertise involves that of cash flow analysis, hence the topic today. So if you would like, you can register as a client. Once again, there's no charge because we are funded by all levels of government, and we can offer that confidential counseling that you see. Now, when we have access to valuable resources, we're actually going to talk about a few of those because they're quite prevalent in the world of cash flow. Those include IBIS World, Vertical IQ, Profit Zones. You get access to leading market research. That market research on the open market would cost you a pretty penny. We pay for subscriptions to those, so we're able to pull that data for you upon request. And once again, that's going to be critical when we actually want to benchmark what's going on with the cash flow analysis of your organization. Just as you see here on the third point, well, we're here to educate the public, offering workshops. Most of our webinars are all via Zoom. There's no charge. You just sign up like you did on Neocera. If you'd like to actually be further informed about what we offer, you simply make sure you're on our email list and you'll get full updates on that. And just as Carol mentioned too, this is being recorded, so it will be posted most likely on the website in the future. And last but not least, we do have specialty programs. One of those includes cybersecurity. Cybersecurity is not the only one. We have specialists in exporting, government contracting, manufacturing, product commercialization, etc. The reason I brought up the cybersecurity program too is that because that is the initiative that I help run here for the South Carolina SBDC. Once again, there's no charge, but I want to make sure you understand that we have many facets that we can help with in terms of your company. So once again, we just wanted to educate you about a little about who we are and how we can help. Now, once again, let's get around to today's topic, shall we? That is the cash flow. I always like to preface this conversation with the following sentence. Assets do not necessarily equal cash flow. When we look on a balance sheet, and that's going to be critical that you understand the basics of a balance sheet in order to understand the financial perspective of your company, but it starts with the most liquid. And the most liquid is that of cash and cash equivalent. You're gonna have many other assets in your company. Okay, like if you buy equipment, you buy inventory, you buy land. All of those are assets, but they do not necessarily mean liquidity. A lot of times when a business, they want to just say, all right, I'm going to look at my taxes, because that's what banks look at when you need to get a loan. And it shows the full annual perspective, and it may even look healthy. But what does that really mean on a month-by-month basis? What does that mean on a weekly basis? Because once again, cash is king. You always hear that phrase, and you hear that phrase for a reason, because without liquidity, your company's insolvent. So I do want to stress, yes, you need to make sure that your assets are healthy on your balance sheet, but particularly we're going to be looking at that of cash flow. Now, the second sentence I got here is the end is the beginning. I like to read right to left when it comes to that of finances. Now, what does that actually mean? Well, that saying is going along this philosophy. I want to know what the end goal is in mind for your company. A lot of times when a business comes to me, they're going to say, all right, I want to make sure that I'm staying liquid. Great. Where do you see this company in 3 years? Where do you need it to be at year 5? If we have a lot of those objectives in place first, we can actually work our way back using Excel data modeling, and it can tell us logistically what we have to do in order to hit that objective in whatever year that may be, year 2, year 3, etc. You know, when I was in the process of developing as a consultant, one of the best pieces of advice I ever heard from a successful small business owner was stop worrying about everything necessarily as the dollar value and start looking at it as a percentage. And that's going to be critical with cash flow. And I really want, if you want to look at the first thing to particularly write down, it is this. Everything is a percentage of sales, or everything is a percentage of total assets. Now, if you're in the beginning stage of starting your company, right, and looking at your cash flow, you're probably trying to figure out what's the forecast for the cost. Oftentimes, when a client comes to me and says, I want to figure out what's going on with my cash flow, I start with the cost first, because the costs are going to be everything. In business, it's not what you make, it is what you spend. And no, I cannot take credit for that. That saying has been long around before me. But the thing I have up here on the third point is that of hard costs versus percentages. Sometimes you are stuck with the hard costs. So let's think about the different types of expenses that you can have. You can have advertising, you can have utilities, you can have rent, you can have wages, etc., right? The first off is figuring out which one of those is what I like to call hard costs. Meaning this, it's like rent. You know, you want to have a place, say, in the city of Aiken, you go there and they say, all right, you know, for the rent, I'm just throwing out a number randomly, right? Let's say it's $2,000 per month. If you want that specific location, you're either going to pay $2,000 a month or you're going to go find yourself a new location. That's what I like to classify as that hard cost. Those things you're stuck in. But sometimes you may have the question of, I got all these other expenses that are critical, like advertising. How much should I be budgeting for? Well, what we need to see is how much it should be as a percentage of sales. Okay. And that's where I'm going with. We start when we're first trying to figure out what's necessary for the operation of our business. What are those hard costs? You know, are we locked into the rent? Are we locked into a debt repayment to the bank? Are we locked into an insurance premium? Those are the things, once again, we're kind of stuck with for the moment. The others are going to be treated as much as a percentage, okay? As I told you, everything's a percentage of sales or percentage of total assets. So there's a simple formula I just want you to write down. It's going to require for just two elements. One is whatever the line item is divided by your sales, and that means all your revenue. So that could literally be your advertising divided by your revenue. You can do this in a month. You can do this in a year. You can do it in a day, a week. Whatever it is, that simple formula is going to work to be able to determine how much of that expense is a relation to that of your revenue. Now, we can do the same thing for everything that's on a balance sheet. So we're working with two documents here, okay? For the sales, we're working anything that's off of your P&L, your profit and loss, your income statement, basically the equivalent of what looks like on your taxes, right? With those that have a balance sheet, right? So your balance sheet's got your assets, it's got your liabilities, it's got your equity. There is the identity equation that says assets equals liabilities plus equity. It's got to be true, right? It has to balance out. Both sides have to equal each other. For anything that's on the balance sheet, we do the same thing. Whatever that item is, just instead of dividing by sales, we divide it by total assets. Because this allows us to actually see it as a percentage. Now, what do we do with said percentage? Well, that's where when I talked about earlier in those valuable resources, we can compare it to the industry average. Because a lot of times a company may say, well, I'm a small business. I'm only a single member LLC. Why do I necessarily want to compare myself to a large company? Well, because we're looking at it from a percentage base, not a dollar base. You may vary different, you know, based on the amount of money that you're bringing in versus, say, the top company in your industry. But the percentage is probably going to have a similar alignment, or it should. And so we will literally go through everything on the profit and loss as a percentage of sales. And we'll do the same thing on the balance sheet and do everything as a percentage of total assets. Now, we start with the income statement with the sales, right? But we got to have something to benchmark it against. A statistic is only as good as the context surrounding it, right? In this case, that's what we see on the second line, the industry multiple, or called the common size. Now, we have access to Vertical IQ and IBIS World, where they actually say in each report, what we do is we look at it based on your NAICS code or your industry classification, usually a 6-digit number, and it'll tell us, okay, here are the industry benchmarks. Now, the most important statistic, if we're looking at cash flow, is probably the profit margin, okay, which is essentially looking at your net profit divided by, in this case, your sales, right? Because everything's a percentage of sales. But you need to actually dive deeper into it when saying, okay, if I don't, let's say the industry average for the net profit is 5%. For a restaurant, it could be about 5.5%. They're razor thin margins. And you're suddenly only at 2%. Well, we need probably to start getting you closer to that 5%. Part of what we do is actually see the deviation, the standard deviation away from the mean as to your percentage versus that of the industry average. And so what we're able to do is actually look at the individual cost involved, okay? And we can see, all right, is your advertising budget too high? Now, if you actually, most people would say, you got to spend money to make money, and that is very true. But if you actually look at the market research on a lot of cash flow, the advertising percentage as that of sales is usually much smaller. Certain industries do have higher things because they have to keep spending money. But a lot of times you'll see the top companies in an industry, their advertising may be a 1% of their revenue because a lot of what they're relying on is building out the brand equity. Now, you may not have the luxury of that to begin with, right? But it is the goal that you're probably trying to achieve. And so we can go through and see every one of those percentages. Like I said, sometimes you're locked into rent, right? Well, we can compare that to the industry average, and if you're much higher than that and your profit margin is much lower, then that actually we can go through in Excel and we can actually data model and say, we need the percentage of sales in regards to, let's say, rent to be this percentage by changing the revenue involved. And when we do that, it'll actually tell us most likely what the new revenue is needing to be. A perfect example of this, I had one of my clients, they were not selling the product for high enough price, and they were focused on high quality printing. And when we looked at it, their percentage of cost of goods sold was too high. It was essentially about 5 to 10% greater than the industry average. And so what I did in Excel is I actually modeled that calculation, and I said, I need their cost of goods sold percentage to be this much greater by increasing sales. And we looked at the average selling price and we realized they needed to only charge about $6 or $7 more. But when they were able to do that, it's a simple benchmarking calculation with cash flow that ended up improving the cash flow because they were focused on a high quality product. Their price wasn't accurately reflecting that enough based on their expenses, and thus they were able to improve their cash flow. Now, we can do the same thing with the total assets, right? We can see how your cash is a percentage of your total assets. We can see how much inventory is. A lot of times, if a company has a brick and mortar status, we look at the inventory as a percentage of total assets and to see, okay, because you heard about inventory turnover calculations, but we're able to actually identify if this is too high, right? If the product is just sitting there, it's not getting flipped out and sold to that of the customer. So every industry is very different in this. Just because you have a percentage, right? I mean, you can look at one of them and it may say, like advertising 10% of revenue. And you're like, wow, that's significantly high. Now, I can probably say on average that that's true, but your industry average may actually be around 10%. So once again, the statistic is only as good as the context. And that's why we subscribe to these market research companies like Vertical IQ, like IBIS World, to actually see what is the industry average in real time. And thus, we actually have a good comparison because when it comes to data, there's the validity and there's the reliability. We're focusing on whether or not the data is reliable for that manner. Now, what are some calculations we should probably look at outside of those, right? So we can take everything on the income statement, we can take everything on the balance sheet as a percentage of either sales or a percentage of total assets. But if we wanted to take that aside and not compare it to anything else, these are some simple calculations that every company should be looking at in real time. And no, it does not require any comparison. This is entirely internal. Number one is working capital buffer. Now, what does that really mean? Well, in this case, sometimes you always heard the expression, save some money away for a rainy day. Well, turns out that rainy day may have ended up being COVID, and COVID ended up being a lot longer than people anticipated. And your finances had to be able to handle that. Well, working capital buffer in this is simply looking at your average operational expenses per month. So I don't know what number that's going to be. You can easily look at your numbers, run an average across the board. It could only be several $100s. It could be several $1,000. It could be 10,000 or more. Whatever that number is, multiply that by minimum of 3. So let's take an example of your average operational costs are $5,000. All right, I'm going to take the worst case scenario, razor thin buffer at 3 months and say, okay, if it's 5,000 times it by 3, $15,000. I'm going to ask that question, do you have $15,000 sitting in the bank for that? If you do not, you don't even have the bare minimum of a working capital buffer. What I actually strongly encourage of clients is actually to run that times 6 for 6 months. So therefore, if it's $5,000, you need a working capital buffer of $30,000. I'm going to say, do you have that much money sitting in the bank? Because when we analyze a balance sheet for cash flow, there's a ratio that we can look at. It's called the current ratio. It takes your current assets divides by your current liabilities. And if it's like 2, it means for every dollar in current liabilities, you got $2 in current assets. On the industry average, that may even be high. But I'm actually going to compare it to your working capital buffer. Because even if you have a high ratio, but if I look at your working capital buffer and you're like, I really only have about basically a month's worth aside, your company could be in for a rude awakening if there is some financial troubles. And before COVID, I think it was Visa that actually ran a statistics survey, and that 59% of companies actually suffered cash flow problems. Now, I have not seen the post statistics on that, given the COVID issues that arose. So therefore, you can only imagine that statistic has probably gotten worse. So that's the first one I encourage you to look at, because that's what you want to make sure, and you can actually work towards a goal on, is getting that working capital buffer. The second is debt service coverage ratio. This only applies if you have financing through like a bank. In this case, the calculation's once again really simple. It's just your net profit divided by what you got to pay the bank. And usually we calculate it on a monthly basis. You can calculate it on an annual basis. A lot of banks do. But it's how much money you made in net profit, let's say for a month, and how much you got to pay the bank each month. Now, usually your payment's probably going to be close to being fixed, right? Sometimes bank loans are based on variable rates. They're blended, like you may call them. But let's just keep something simple for this scenario. Debt service coverage ratio. You make $10,000 in monthly revenue. Monthly net profit. My apologies. $10,000 in monthly net profit. You have to pay the bank $5,000 each month. 10 divided by the 5, your debt service coverage ratio is 2. Now, the reason I bring this up is because banks will usually have a minimum requirement of 1.25 as the bare basics of what they need. Because essentially, whatever that number is, subtract 1 out of it, and it'll tell you how many future payments you can make to the bank without touching your savings. So let's take an example. 10 divided by 5 is 2. 2 minus 1 is 1. It means you can make not only this month's payment to the bank, you can make 1 more payment to the bank fully without tapping into your savings. That's a pretty healthy ratio. But once again, we want to compare it to that of the industry average. Now, I took that same philosophy and I turned it to the owner's side, meaning you. And what I like to call this is the owner's coverage ratio. No, I guess I really probably did not make this up. It had to clearly be around in some form before me. But I took the idea of the DSCR and decided to treat it as you as the bank, because you're putting in your own money to start the company. So therefore, naturally, you want to be able to pay yourself. And this is something that I look and calculate in real time for my clients. Instead of the net profit divided by the monthly repayment to the bank, it's your net profit per month divided by how much you pay yourself as an owner's draw. Now, I realize some of you may actually be taxed differently, like a corporation. If you keep making enough money, you may end up paying yourself a W-2 salary. That's fine. Whatever it is, that's how much you're going to pay yourself. So let's take this scenario, right, of like $10,000 in monthly net profit. Let's assume you don't have any debt. You're just, in this case, paying yourself, and you pay yourself $5,000. 10 divided by 5 is still going to equal 2. 2 is an ultimate goal here with owner's coverage ratio. And if you're writing stuff down, please, I want to reiterate that again. 2 is the ideal owner's coverage ratio here, because it's a 1-to-1 match. Because 10,000 is the monthly net profit. You paid yourself 5,000 after that. The remaining is 5,000. So your company grew at $5,000. Your personal checking account grew at 5,000. It's a 1-to-1 match. But I use the same minimum philosophy of 1.25, which essentially means you're retaining about 80% of the company's money is going to you, the individual. You're keeping about the rest in the actual LLC account. And in my Excel cash flow documents that I work with clients, I do a minimum and a maximum owner's coverage ratio. The maximum does a 1.25, so you're paying yourself more money. The company account's not growing as much. And then the ideal one would show where it's a one-to-one match. So the reason I got GoalSeek on here, Excel simple tool I use, I just plug in, I do it with debt service, I do it with owner's coverage ratio. I just say, all right, here's the target ratio it needs to be, and it sets it at that amount by changing the amount of revenue that needs to be brought in. And it allows me to actually factor all of these into real time. So these are three simple cash flow calculations. Sometimes I think they get overlooked, but I think they're probably going to matter to a full scope of businesses. The second one's only going to apply if you have debt. Okay. But let's say you were thinking about a loan. You can go ahead and actually calculate what that monthly payment would be, factor it in and see, do you have enough debt service coverage ratio? Because that's what underwriters actually do when you are actually applying for a business loan. Do you have strong enough debt service coverage? But also don't forget about paying yourself, because if you can't pay yourself, why are you in a business to begin with? Now, assuming that you do need financing, right? With the cash flow analysis, I wanted to stress once again, that's why I kept the slide up here. It's the P&L and the balance sheet, because everything's going to revolve around. I talked about doing the benchmarking as a percentage of sales, benchmarking as a percentage of total assets. Those are the two documents they're going to need. Now, if you are in the pre-venture stage, or perhaps you are maturing as a company, but you are going to need loan financing, let me just reiterate once again. The things like that are in the business plan, it's narrative, that's great, but it's built around the numbers. And as long as those numbers are reliable, that's going to become the foundation of everything we do, from the business plan to the loan package, etc. Okay. Now, this is probably the thing I need to throw out there. That is a fundamental for you in order to do cash flow analysis. It's that reliability. We want to make sure your books are accurate. Do you even have a profit and loss statement? Now, if you're in business, at the worst case scenario, you're going to have to produce a Schedule C as a company. Now, that's going to be an annual perspective of it, but at least we give us something to work with. This is why I encourage clients, if you can, to use QuickBooks or put together a basic balance sheet in Excel. And I can help you as a consultant do that if need be. But you have to have those two documents in real time, because if you don't have real-time knowledge about what's going on with your company. And sometimes cash flow problems do arise, and they'll hit you like a freight train if you're not aware of them. And that's why you want to have that real-time knowledge going there. But once again, if you do need financing from a cash flow perspective, because the bank wants to actually size up where you are in relation to the industry average, you're going to need to have these two documents in place. They're probably going to look at everything as a percentage of income as well. They're going to run debt service coverage ratio. But once again, anytime you plan on building a business plan, even if you don't need to get a loan package, if you never hit that third step, it's still based around those numbers. And those numbers are reliable, then you have a great road path to moving forward when dealing with your finances. Now, this kind of just gives a little bit of a precursor into what Dory's going to talk about too, but it's something I encourage your clients, such as yourself, to look at in real time. And that's what's going on with the credit and the collateral, because if you do need to get financing, and hence the cash flow and the credit portions are both equally important, I encourage clients to look at what's going on with their FICO score in real time. If you're 680 or plus, 680 is usually the magic number with SBA loans. Dun & Bradstreet has their own business credit score. It's called PAYDEX. You want to make sure that you're 80 or above. And in some cases, I've even seen where people want 85. Now, the PAYDEX is a business credit score. It's kind of academic in nature. It's 0 to 100. You want to be 80 or above, or in this case, 85. If you can get a perfect 100, that is even better. And it's going to put your company in much better position when you need to go get financing. And this is something I encourage clients to do as well. And it actually ties back to the financial analysis, particularly that of your balance sheet. When collateral, right? So you go get a loan for that Ferrari, you need to figure out what assets that you can pledge that the bank could actually, in this case, liquidate if the loan were to go south. Well, you can always look at what are a schedule of potential collateral assets. What's the best place to start looking at that? Your balance sheet, because your balance sheet is going to list them out. Yes, cash could be collateral. Accounts receivable theoretically could be collateral. You may not like the interest rate involved on that, but also too, what's going on with the equipment? What's going on with the land? Do you have any other vehicles? Hopefully we don't have to turn to inventory ever as a scenario for that. But once again, it ties directly into the financial analysis when you're looking at your balance sheet for that case. So naturally, it's going to be a good lead in for what Dory's going to discuss with the element that of credit. Now, you have heard me mention QuickBooks before. I don't know how many of you are actually using the program in real time, but if you decide to, right, There's some great tools we can do. One of the things that I actually encourage, unless you have advanced version of QuickBooks Online, is just export what we need in detail. I can export the profit and loss. I can export the balance sheet. We actually work with the company, in this case, ProfitSense, to pull those real-time benchmarks for the industry, where we can see everything as percentage of income, everything is percentage of total assets. But also, too, it's good for actually looking at what's going on with your accounts receivable and your accounts payable. Those reports are easily going to be pulled, and I can see in this case, well, how longer before we actually get paid from these customers, or before we ended up actually having to pay the vendors. That third point, I do want to throw that out briefly, and I encourage this of you, anything when you try to consider the purchase of a new transaction. It could be advertising, it could be a new piece of equipment, etc. And that is marginal benefit is greater than or equal to marginal cost. It's a fundamental of economics. Usually a lot of textbooks put it as the third, but I think it's certainly appropriate. Like if you are going to work with an advertising firm, or perhaps even pay for a simple ad, well, you have a cost attached to it, but what is the benefit? How many new customers or clients are being generated based off of those initiatives? And that's the thing. When you are in business, you've got actuals. You can actually look at that and see what is the benefit related into the cost of those items. As I mentioned, some companies, of course, have cash flow problems. You know, the nice thing about QuickBooks, or we can do this in Excel or whatever program you have, is through the equivalent of Performance Center, we can actually look at the percent change. We can see not only at the percentage of revenue, everything is percentage of revenue, like I keep talking about, or percentage of total assets. We can actually see what's the increase per month. We can see the increase per year. Hopefully it's a positive. Sometimes it's a negative, and that's why we end up diagnosing and seeing where are the issues that we can help. Usually speaking, the best strategy is going to start to minimize discretionary costs. It could be the thing where we're just not selling our product or service for the high enough price. I have quite a few models that we can look at to actually determine if that's the case. But discretionary costs are those things that are non-essential. That does not mean you're cutting out advertising if that advertising is actually generating you revenue. It could be maintenance that's not required at the moment. You know, it could be donating to charities. I know that doesn't sound great, but if you're in a financial issue, you know, it's better to actually not donate to charity for, say, 3 months while you recover your operations, and then continue and improve your efforts with the charity. Otherwise, you're out of business and you're never going to be able to give money to said charity later. You know, those are the hard calls that sometimes have to get made. A lot of times businesses will look at buying used equipment. I will say that can be a catch to that. If it's used, you're probably going to get less collateral value. You need to figure out what's the potential repair and maintenance cost, the upkeep involved on that, because you may save some money to begin with. You may lose a lot of money right after, because the thing is not quite a lemon, but it's going to keep nickeling and diming you for quite a bit. And one of the last things I have just for my food for thought statement is that of inventory. And so I like to always use this formula up here when determining what is the amount of inventory that we need to keep ordering and at what speed. This is just a sample equation, but the reason it get brought up is because COVID caused a lot of supply chain issues, and it made companies worried that they could not get their raw materials in order to produce their product. And so a lot of times they ended up overbuying. They'd look at this calculation and then probably add a little buffer on top of it and say, well, I know normally this would be sufficient, but I got to make sure I actually have materials. I had one restaurant actually shop around every day, and they overbought on some cases, because they wanted to make sure they could actually make the food at the end of the day. But hopefully the supply chain in this case, things are normalizing quite a bit. But it's just one of those things to consider through that process, especially if you're sizing up inventory as a percentage of your total assets, okay, or cost of goods sold. Any of these work. The last two things to point out is building supplier relationships, okay? Because I'm sure First Citizens will mention here, there are some strategies that you can use to build business credit. And one of those is potentially, lines of credit with your suppliers, but more importantly, that you have a good relationship, because if there are cash flow problems that do arise, that you have a little bit of a buffer, because once again, it's a human relationship, and they realize that you want to continue working with them. Because if you decide to not be as nice of an individual, have a poor relationship with your supplier, something goes wrong, there's a good chance you're not going to have a get out of jail free card, so to speak. And last but not least, I cannot stress cash, and more cash. That working capital buffer. Look at your operational cost per month on average, times it by 3, times it by 6. And there were some companies, probably, I can't remember if it was Microsoft or Apple, that actually looked at it and said, we won't have enough cash to survive for 3 years if we never generated revenue for one bit. That's taking it to the extreme, but it's still considered looking at the working capital buffer. I know we're limited on time, so I want to, in this case, give plenty of time for First Citizen, for Dory to talk about that of the credit component. But once again, if you want any time, ask any questions at the end. Also, too, you can sign up as a client anytime, and we can go through in depth. There's so much this topic involves, but I'm trying to give a macro level approach to it. Therefore, we can turn the discussion over to Dory. Dory, the floor is yours.
Hey, Brent, can you hear me?
Yes, I can.
Okay, good. Thank you. I do work at First Citizens Bank, and I've been with First Citizens for over 16 years. I was born in Aiken, and I've raised my family here as well. I work at the Aiken main office, and my counterpart, Carol Albion, she is at the Whiskey Road office, and we're both business bankers, business officers, and we work with small businesses to help them with their banking solutions, with their busy lives every day. A little bit about First Citizens. We are the largest family-owned bank in the United States. We were established in 1898. We have over 17,000 associates, 550 branches, and are in 17 states, and 214 billion in total assets. So y'all please come see us. So today we're going to talk about personal and business credit. They are somewhat similar, and they work together. So we'll start with, what is your credit report? So a credit report basically is your history, what you have done in the past. That's reviewed by banks when you go in to apply for a loan. It's how you've handled your accounts in the past. Credit reports, they're used to help decide if we want to lend money and at what terms. Depending on your credit score, can also determine what interest rate you might get for your loan. It's important to check your credit reports regularly to make sure the information is correct and accurate. With fraud, identity theft, the dark web, all those can be used against you. So make sure everything's accurate with your credit reports. There are 3 major credit report bureaus in the United States: Equifax, Experian, and TransUnion. You may not see the same information on each report. Some lenders don't report to all 3. For First Citizens, we do report to all 3, but we only pull Equifax for your personal credit requests, and Experian for the blended personal and business score. So if you look at the next chart, it shows you what makes up your credit score. So the number one, or the most heavily weighted part of that, is your payment history. Late payments will lower your score, so make sure you do pay your bills on time and don't skip a payment. One thing I've always told my kids is, if you have a problem, go to your teacher and ask for help. The same way I feel about if you're in a bind or need extra time, go to your bank, talk to your banker, talk to whoever you're dealing with, maybe even a medical bill or something. Make arrangements to have a payment plan, or banks do offer extensions that can help you. So come talk to us, don't let it slide. The next percentage is amount owed. So the number we kind of look at is, if you can keep your utilization under 30%, that helps build that score for it to stay high. Even if you pay off your payments in full each month, if you maximize or fully use up a card each month, that can actually make your score go down. The next is new accounts. Having too many new credit accounts inquiries can lower your score. You'll see the note on there. Multiple inquiries for the same auto or home loan will not. So they do recognize if you're shopping that you may be looking at different institutions for the best deal. And then the last two are length of history and types of credit. With length of history, a short history isn't a bad thing if you can show responsible credit. But the other side of that too is some people will pay off a credit card and say, I want to close it. But having that card open for a longer amount of time, if you're able to manage that, will also help your credit score. And then the types of credit, having a variety of different types, mortgage, student loans, credit cards, all that can also boost your credit score. And so the next screen shows what is considered good credit. So they range from 300 to 850, and the higher the credit score, the lower the risk to the lender. And then the following items can affect your score: the amount of inquiries, late payments, collection payments, and bankruptcies can all affect that score. So anything below 580 is poor, and that's kind of well below the average score of the United States. And lenders do consider that to be a risk. 580 to 669 is below the average, but there are some loans out there that you are able to get a loan for in that range. The next is 670 to 739. This is about average, and most lenders do consider this to be a good score. 740 to 799 is very good and above the average, and it shows lenders that the borrower is dependable. And then anything over an 800 is obviously very low risk. Bankers would not have any problem with that. And most of my clients that have that 800 score are very proud of it, and they've worked hard to get that, and they definitely wouldn't do anything to lower that score. Right, and then so a little bit about your business credit score. It is somewhat similar to the personal in that there is a score range, 0 to 100, and I know Brent had touched on that. 0, is a higher risk, whereas anything closer to 100 is a low risk for the lender. There are several things, I won't go over all of those, that are considered when calculating the business credit score, somewhat similar to personal. Think about normally, at least from the personal side, you could have information from your trade accounts, from other lenders, any kind of legal filings from local, county, and state courts, obviously collection items, and then the company background and comparative data that places company payment performance in context with this industry. They kind of look at, what other companies compare to you. They will analyze that as well. So that's kind of how that business is looked at, that score. Some of the factors that will affect your business credit score, there are over 140 variables, but a few are, of course, the common: derogatory public records on the business profile, collection, liens, judgments, and bankruptcies, the status, frequency, dollar amounts of any liens or judgments or bankruptcies. If you have an increase in slow payments, an increase in the number of new inquiries, number of trade experiences, balance outstanding, credit utilization, like we talked about before, and then your years in business and the particular code, industrial code for that business, size of business, and demographic data. All right. So there is a standard. It's actually a government guideline that that is used for the data that's on file. So it's important that we have the guidelines for how long and that the information we have is accurate and current. So the trade data is 36 months, that all this will appear on your report. 36 months for trade data. Bankruptcies is 9 years and 9 months. Judgments, 6 years and 9 months. Tax lien, 6 years and 9 months. Uniform commercial code filings, 5 years. Collection, 6 years. And bank and government and leasing data is 36 months. So that information is nothing older than that would be used. So then your personal credit versus your business credit. In order to get started, a lot of times you do have to use your personal credit in order to run the business. But if you can avoid that, it's always better, just because if your business ever were to slow down, that's going to affect your personal credit as well. And it also kind of affects your personal borrowing ability, because your debt to income ratio, even if the business is paying for it, would be affected if your business truck or loans are under your personal credit. And creditors today are moving away from relying on personal credit of the borrower. They're now judging the business financial health on the credit score of the business. And then for sole proprietors, the personal and business credit are closely linked, so it is important to take steps to protect both of those. All right, and then some key takeaways. Personal credit and business credit both do determine your lending options. Using personal credit for business use can impact your ability to borrow personally, even if the loan was used for your business. Previous history and ability to repay are the #1 factor for whether you can borrow money. And income that would result from doing a loan is not considered in most circumstances. So your future revenue stream is not considered in whenever a loan request is being made. And then strong business credit will not compensate for low personal credit. And then the things that you would consider for your business, consider the same things you would for your business credit as you do for personal credit, such as inquiries, use of revolving debt, on-time payments, etc. And then the #1 takeaway would be, regardless of the amount of credit a lender may qualify for you, it's your responsibility to yourself to realistically decide what makes sense and what you can comfortably handle. I know a lot of times if you apply for, say, a pre-approval on a house, the bank's typically going to give you the max that they think from a debt to income ratio that you can afford. But, overextending yourself can lead to financial disasters, financial consequences for years to come. So make sure you take into account things like slow business, no business, unexpected expenses, and anything else that might impact the amount of money you're bringing in to pay expenses.
Thank you, Dory. And as you can see, I mean, not only is this being recorded, but we wanted to make sure you had a contact information for both of us. Because, I mean, obviously you may need to get financing. So, I mean, if you'd like, you can talk to First Citizens and, see if your business, would qualify for any of the loans. So